Is the Fed still independent, or is it now playing politics? The data says the economy is strong, so why does it feel much weaker on the ground? And if inflation is supposedly beaten, why does nothing feel cheaper? According to former Federal Reserve insider Danielle DiMartino Booth, these contradictions aren't accidents. They're the result of broken data, political pressure, and a financial system that rewards asset holders while quietly squeezing workers. If she's right, ignoring those signals now could make the next decade far more painful than most people expect. Hello everyone, and welcome back. This podcast summary video is based on Danielle DiMartino Booth's recent appearance on Coin Stories. This was a fascinating and eye-opening conversation that covered Federal Reserve policy, debt dynamics, generational wealth, housing pressures, and Bitcoin as a hedge for ordinary investors. The whole conversation is almost an hour long, but we listened to it all and organized the most important ideas into a clear, straightforward summary, so you get the key takeaways without having to listen to the full episode. If you get value from our summaries, please like the video, subscribe to the channel, and comment your thoughts below, because that really helps the channel and keeps this content coming your way. Danielle begins by challenging one of the most deeply held assumptions in finance, that the Federal Reserve operates independently of politics. Drawing on her time inside the Fed, she argues that independence has been eroding for decades, but today it has reached a breaking point. Jay Powell's refusal to cut rates, despite inflation readings near 1.2 to 1.6%, is not just about data, it's about power. Powell's term as Fed chair ends in May 2026, yet he can remain on the board until January 2028, giving him leverage even after stepping down. Prediction markets once placed a 90% probability on his exit, but political pressure has paradoxically strengthened his position. She traces this dysfunction back through multiple Fed chairs. Alan Greenspan normalized market favoritism. Ben Bernanke openly leaned political by the end of his tenure, and Janet Yellen blurred the line between monetary policy and ideology. Powell initially resisted market pressure, but reversed course after the 2018 market collapse, fully embracing QE and crisis intervention. Danielle argues the result is a Fed trapped between credibility and control, using high interest rates not as a neutral tool, but as a signal of authority, even if it harms the real economy. From monetary policy, Danielle shifts to what she sees as the most dangerous misrepresentation in the economy: labor data. Headline unemployment suggests stability, but beneath the surface, the picture is alarming. For workers aged 22 to 27, underemployment is roughly 47%, while official unemployment for that same group is reported around 10%. These are not marginal workers. They are recent graduates and early career professionals who traditionally form the foundation of economic mobility. When the first rungs of the labor ladder collapse, long-term growth collapses with them. She explains that these distortions allow policymakers to justify restrictive policy long after it makes sense. While inflation prints are near or below target, rates remain elevated, squeezing small businesses, increasing closures, and cutting off job creation. The winners are asset holders, private equity, private credit, and the top 10% of households, while wage earners absorb the cost. Danielle is clear. Rates should never return to zero, but keeping them artificially high in a low inflation environment functions as a silent tax on labor. Danielle views gold as one of the clearest signals that global confidence in fiat systems is quietly weakening. Central banks across the world are accumulating gold at a pace not seen in decades, while governments simultaneously ramp up military, spending, and long-term fiscal commitments. Add to that aging populations, particularly in developed economies, who are shifting from growth to capital preservation, and the demand picture becomes structural rather than speculative. Gold, in this context, isn't reacting to headlines. It's responding to deep shifts in demographics, geopolitics, and trust in monetary stewardship. At the same time, Danielle is clear that recent price action has pushed into excess. A $500 single-day move is not healthy price discovery. It's emotional positioning. She recounts hearing taxi drivers confidently predict gold prices of $10,000 to $15,000, invoking the classic shoe shine indicator, where mass enthusiasm often signals short-term risk. While she remains bullish over the long run, she cautions that pullbacks are likely and healthy. Importantly, she does not believe the world is returning to a gold standard. Treasuries remain dominant because, in moments of crisis, governments still issue debt in dollars. However, foreign ownership of U.S. debt is declining, and the 2022 weaponization of the dollar accelerated the global search for alternatives, with gold serving as the most immediate release valve. When the conversation turns to Bitcoin, Danielle takes a deliberately unsentimental stance. She describes Bitcoin as the riskiest asset on Earth, not as a critique, but as a classification. In its current market role, Bitcoin is not behaving like gold or a traditional safe haven. Instead, it functions as a high-beta expression of global risk appetite. When liquidity is abundant and confidence is high, Bitcoin performs exceptionally well. When stress enters the system, capital still moves first into gold and cash. That distinction matters because it shapes expectations. Danielle acknowledges Bitcoin's growing importance as a macro signal, even if it hasn't yet matured into a crisis hedge. Its underperformance relative to gold reflects fear, not failure. Younger generations increasingly view Bitcoin as protection against currency debasement, but markets continue to price it like speculative technology. She emphasizes the difference between nominal and real performance. Assets can rise in dollar terms while losing ground against gold or hard assets. Bitcoin's role is evolving, but Danielle stresses that investors must understand what it is today, not what they hope it becomes tomorrow. One of Danielle's most underappreciated warnings centers on passive investing, which she views as a hidden source of future instability. Research suggests markets become structurally unstable when roughly 83% of capital flows move passively, without price discovery. Today, that number is already just over 50% and still climbing. Passive strategies work exceptionally well in rising markets with steady inflows, but they rely on assumptions that rarely hold forever. Constant liquidity, predictable retirement behavior, and limited forced selling. Those assumptions begin to unravel as baby boomers fully retire by 2029. Instead of contributing capital, this cohort will increasingly withdraw funds to cover living expenses, reversing decades of steady inflows. Danielle warns that a return to zero interest rates would only accelerate the problem by stripping savers of income and forcing more withdrawals. This is not a timing call. She emphasizes it's arithmetic. When passive dominance peaks, markets lose the ability to price risk accurately. Liquidity disappears quickly, volatility spikes, and what once looked stable becomes fragile almost overnight. Beyond markets, Danielle paints a sobering picture of the political and social landscape forming beneath the surface. Rising inequality, labor frustration, and institutional failure create fertile ground for radical change. She warns that the drift towards socialism is not being driven by ideology, but by desperation. As more households struggle to maintain living standards, pressure builds for redistribution, expanded welfare, and heavier taxation, particularly on a shrinking middle class. She draws a stark historical parallel, noting that the last time political turnover appeared this chaotic, Abraham Lincoln was president. Yet despite the gravity of her warning, Danielle is not fatalistic. She believes public frustration with ineffective governance is reaching a breaking point, and that backlash is inevitable. Reform, in her view, will not come preemptively. It will come only when pressure becomes impossible to ignore. The danger is not collapse itself, but the cost of waiting too long to act. Danielle closes the conversation by translating these themes into practical investment implications. Valuations are stretched, with the Shiller Cape near 41, just below the 44 peak seen in 2000. At the same time, AI investment has shifted from being cash flow funded to debt funded, increasing fragility across markets. She favors utilities for their stability, remains cautious on financials due to unresolved commercial real estate risk, and repeatedly emphasizes the importance of understanding personal risk tolerance in an environment dominated by speculation. Her core message is clarity, not fear. The danger lies in believing surface-level stability while ignoring deeper signals. Labor markets are weaker than reported. Policy decisions are more political than admitted, and wealth continues to flow upward through structural design. Investors who recognize these realities can position themselves accordingly, not by chasing narratives, but by respecting signals, managing risk, and preparing for a system under increasing strain.